Welcome back to Sign On WS Radio's Business Networking Radio with your host, Jesse Lipscomb.
And welcome back to Business Networking Radio right here on WSRadio.com. I'm your host, Jesse Lipscomb. Got a great show today. Joined in studio with my co-host, Jeff Ensign. And we're talking tax talk today from a seminar that was called 7.5 Powerful Strategies Used by the Wealthy. I'm able to highlight a partnership I have with the Gradient Tax Team. It's a team of CPAs that help individuals and businesses in all 50 states. What makes them special is that they focus on retirement solutions. They're a CPA firm. They're helping you maximize your deductions and lower your tax liability with a keen eye for opportunities which will help you enhance your retirement, which is perfect for me because I specialize in retirement planning, Jeff. So in this seminar, we're going to focus on strategy number 5. Okay. What's better than deferring taxes?
Not paying any taxes.
That's right, because there's 3 ways of taxation. You have tax now, current taxable, like CDs. You have tax deferred, which is like your traditional IRA, 401k, or non-qualified annuities. Annuities by themselves are tax deferred. And then you have tax never. I think that the right word is called tax advantaged, but basically you don't get a deduction today, but you don't have a tax liability tomorrow.
Right.
Okay? So specifically, strategy number 5 is don't pay taxes.
Pretty straightforward.
Although certainly we don't want to, we want the IRS auditing us here.
Right.
But no, what we're saying is don't pay taxes on money that you don't have to.
Right.
Okay? Defer and or get tax advantaged vehicles that can help you. So showing Jeff a picture here. Do you know who that guy is, Jeff?
Oh, I cheated. I saw.
Yeah, you saw the answer. All right. Well, that is William Roth Jr. And this year, Senator Roth's name has really been in the news a lot because of the Roth IRA and what's happening with it. So let's give a quick overview of Roth IRAs. Unlike a traditional IRA, Roth IRA contributions are not deductible. However, whereas a traditional IRA is 100% taxable when you take it out, it's absolutely tax-free so long as you adhere to the rules. It's totally tax-free when you take it out. There are no required minimum distributions during the owner's life.
Oh, really? I did not know that.
And just for our listeners, a required minimum distribution is in a traditional IRA 401k, you have to, whether you want to or not, you have to take out money once you turn 7.5, or there's a 50% tax penalty, an excise tax, on which you should have taken out but didn't. And that's right
50%, wow.
And that's right per IRS publication 590. Yeah. Roth IRA gives you some tax diversification and estate tax benefits. Makes sense. Mm-hmm. Being able to choose when you want to take that money out. It also can potentially lower your tax on Social Security income. The reason why is since it's tax-free money, it doesn't count in the calculations towards Social Security taxation. Oh. Real easy. If your income in retirement is over a certain level, if your taxable income in retirement is over a certain level, up to 85% of your Social Security benefits can be taxable.
And a lot of time people go over that limit by taking an IRA distribution.
Because it's a required minimum distribution,
right,
whether they want to or not.
Yeah.
And so had that IRA actually been a Roth, you still could have taken the money if you wanted it, needed it, but it wouldn't have had that negative effect on the Social Security income. And you're more likely to be eligible to deduct medical expenses, kind of the same way. Because the income's tax-free, you increase the likelihood you'll be able to deduct qualified medical expenses. The 7.5% rule talks about you can deduct medical expenses over 7.5% of your adjusted gross income.
Adjusted gross income? Is that correct?
And so, long story short, if you're taking money out from an IRA, you're increasing your income. If you're taking money out of the Roth IRA, it's not taxable income. So it's
a way to plan. It's another way to plan.
Absolutely. Now we're out here, rural parts of San Diego. So if you were a farmer, Jeff, okay, would you rather pay taxes on the seeds or would you rather plant the crop and then pay taxes on the harvest?
On the harvest, of course.
Okay, that doesn't make any sense. Let's think about this. You can pay taxes. You buy seeds, $100
You want
of
it
seeds.
on the seeds, yeah.
Okay, a small amount, and then you plant these seeds, and they become $100,000.
Yeah.
Would you rather pay the same percentage on the seed or the harvest? Obviously,
On the seeds.
Intuitively, it makes sense to pay taxes on a lower amount.
Right.
Okay. Well, math is a funny beast. If you had $500,000 in a traditional IRA, after many years of interest and growth, well, if you were in the 25% tax bracket, 25% of that, $125,000, you'd have $375,000 left. Okay, boom. On the other way, okay, that $125,000 that you'd spent in taxes, okay, growing a certain number of years, certain interest, same, it'd become $375,000. It doesn't matter.
It doesn't matter which way you go.
If taxes don't change, given the same amount of interest, the same number of years, okay, the net money you'll have in an IRA or a Roth IRA will be the same. Okay. However, if taxes are going up, that can change the whole dynamic there.
Right.
Okay? Because essentially a Roth conversion is tax neutral on the first day. The benefits of whether or not it's going to save you money will all depend on where your tax situation is going to be. Is your income going to be higher? Are tax rates going to be higher? And whether or not you're going to want to control distributions or be forced to take them through the required minimum distributions. Okay? So along that line, Roth IRAs are not for everybody. Okay? A Roth IRA only makes sense, like I said, if tax rates are going to be the same or higher during your distribution period. Okay? If you intend to pass the assets on to your beneficiaries, that makes sense. You'll pay taxes on the money now to give them the money tax-free later. And we talked a little bit about stretch IRAs in the last segment, basically multi-generational IRAs. You can do that for both a traditional and a Roth, basically taking the asset and stretching it over the life expectancy of your heirs. If it's a Roth, it won't be taxable. If it's a traditional IRA, 100% of it will be taxable. Okay. If you want to reduce the size of your taxable estate, this is kind of interesting. Yeah. Let's say you had $1 million and it was sitting in a traditional IRA. Okay. And you had another $500,000 that was in just the bank. Okay. Well, if you convert that $1 million to a Roth, really easy math, state and federal taxes, 40% plus 10%, boom. 50% tax on it, that's $500,000. You could take the money from the bank, pay the tax on it. Yeah. Well, your estate's just gone down by $500,000, right? You had to spend that money.
Right.
However, that new converted Roth IRA is 100% tax-free when you pass it on. Yeah. So if you got 7.2% growth on that $1 million, in 10 years it's now worth $2 million.
Right.
And that $2 million is tax-free versus, a $2 million taxable.
A $2 million taxable at that time, yeah. That makes a lot of sense.
And, again, you can pay having the ability to pay the conversion taxes with after-tax money, or non-IRA money may make a lot of sense as well. So it's just, it's not perfect, but when we look at the future of taxes, if taxes increase, if you think they're going to increase, it may make sense to pay taxes now and not worry about it later.
Give you another option.
Yeah. And really all Roth IRA conversion is you're converting it from an IRA, which is taxed in the future, to a Roth that's not.
Right.
It's really easy. The cool thing about 2010 is that the income limits for conversion have been removed. Prior to this, you couldn't convert it if you made too much money. Plus, you can split it over tax years 2011, 2012. You've been listening to Business Networking Radio right here on WSRadio.com, the worldwide leader in Internet talk.